Fixed rates just got cut again, even though the Bank of Canada did nothing. And you would think that that would leave interest rates pretty much where they are. But that's not the case. Over the last couple of months, we've seen interest rates jump a bunch, then we've seen them fall, then we've seen them jump again. And the reality is, it's a really volatile market when it comes to mortgages. And this is largely because of the bond market and the surprising numbers that keep coming with respect to inflation, jobs, and a whole bunch of other economic indicators, both in the US and Canada. So, if you're watching this video, it's probably because you have a mortgage coming up for renewal, or you're thinking about getting into the market and you're interested in what is happening with mortgage rates, which is why I want to start this video by telling you something very important. If you're thinking about getting into the housing market and you think you might be 4, 6, or 12 months out, it's really important that you start locking in rate holds for fixed rates because you can lock in rate holds for a 4 month period, which will protect you if interest rates do go up. And they jump quite significantly even when the Bank of Canada is doing nothing. In fact, since January, we've seen more than a 0.5% increase and decrease in interest rates, or a 0.5% zone interest rates have floated around in, which means that if you have your timing wrong, you could end up having to pay a higher interest rate. And if you have a mortgage renewal coming up in the next 4 months, well, you want to make sure that you start talking to somebody right away so that they can start locking in rates and protecting you. And don't go directly to your bank because if we call a spade, they don't have your best interest at heart. Neither does anybody who works for a lender who is trying to renew you. They're there to get you to stay. And in a lot of cases, unfortunately, that means they will say whatever they need to in order to get you to stay. So seek out a good mortgage broker and have them help you navigate the world of renewing your mortgage. And by the way, if you don't have a good mortgage broker or you want a great mortgage broker, my team at Mortgage 360 is here to help you. I have the single best team of badass women who are paid completely on salary so that you don't have to worry about whether or not they are trying to get you to take one type of a mortgage or another in order to get paid more. They're there to do what is in your best interest and your best interest only, which is how we got certified as the first B Corp certified mortgage company in North America, which, by the way, doesn't mean we're a B lender. It means that we have a certification around being a business as a force for good. It's the same certification that companies like Patagonia, Ben and Jerry's, and other businesses that put their clients first have. So if you need help and you want a great mortgage broker, go to mortgage360.ca. And without further ado, let's talk about mortgage rates and where they are as of right now. So if you're new to the channel, let me explain how these mortgage rate updates work. Basically, we go through 5-year fixed and variable rates, and we also talk about a little bit later on the discounted mortgages that are available because just like everything else in life, you get what you pay for. And if you're getting a very cheap mortgage, well, you're getting a very cheap mortgage. And there are certain things that the lenders have done to make that mortgage more profitable, even though on the surface you may feel like you are paying less because you have that lower rate. I'm going to talk about what all those differences are a little bit later on. But first, let's talk about the full featured mortgages. These are the best of the best mortgages in the industry. They are not bank mortgages. We call the banks the B lenders because they actually have inferior products relative to many of the other lenders. Because if the other lenders didn't have better products, well, they simply wouldn't exist. So we call lenders like MCAP, First National, CMLS, are A++ lenders because first, they only take the best of the best clients. And second, they actually have the best of the best products. So when I go through these full featured rates, this is what I'm talking about. Mortgages that have good prepayment privileges, which doesn't matter for everybody, but also have things like better terms and, more importantly, especially if interest rates do start to go down, lower payout penalties, which can be hugely beneficial if those rates go down. And you want the option to refinance into a lower rate at some point in the future. Because if you have a big bank mortgage at a B lender, B is for banks, well, the chances of you getting a lower rate midterm are pretty much slim to none. And that's all to do with how the payout penalties work. So, starting with our 5-year fixed full feature mortgages right now, again, these are from lenders like MCAP, CMLS, First National. Interest rates have actually come down this month. This is even though the bond market was super crazy. The current best rate that you can get on a full featured mortgage that has all the bells and whistles and low payout penalties is 4.99%. Now, mortgages that are insured are typically the cheapest because they are zero risk to the bank. They have insurance, which means that if you default, they aren't going to lose any money, which is why they are cheaper. It used to be in the past, if you put 20% down, you got a better rate. Those days are long gone because now 20% down is the point where the bank has the most exposure because they no longer have the insurance. And by the way, there is a chance that property values can come down 20%. We learned that in 2023. And therefore, this creates a scenario where people could potentially walk away and turn back the keys. Now, if you are putting greater than 35% down, those mortgages are still deemed very low risk. So they're priced very similar to those insured mortgages. Now, if you're putting 30% down, you can see as you start to put a lower down payment, the interest rates start to go up. Those are now 5.09% relative to 5.29% last month. Then at 25% down, you're looking at 5.14%. And at 20% down, you're looking at 5.24%. Now, there are certain circumstances where mortgages are priced even higher, and that is when you are getting what's called an uninsurable mortgage. So, this is a mortgage where the lender or the bank can't buy what's called portfolio insurance, and therefore these are more expensive. So, the cases where this might exist is if you are refinancing your mortgage, if you were getting a mortgage on a property worth more than $1 million, or if you were getting a 30-year mortgage instead of a 25-year mortgage. Now, as you can see, all of these fixed rates have come down pretty substantially since last month, which is good news. But they could just as easily go up in the next week or 2 weeks or 3 weeks or 4 weeks, and they could come down even more. We don't know because bond markets are independent of what the central banks do. And therefore, if you're waiting for a central bank announcement for lower rates, well, the market can actually price those in a lot sooner than when there is actually a Bank of Canada rate decision. Now, as we get into variable rate mortgages, the ones I'm outlining here are typically variable rate mortgages with adjustable payments, not the fixed payments that have become such a huge problem. And again, these are with lenders that have very low lock in rates, low penalties if you do lock into a fixed rate mortgage, and just in general have the best features. So, for an insured mortgage, these are pretty much the same. They've been pretty much the same the entire year. Prime minus 0.90 on an insured mortgage. When you get to 35% down, again, around the same rate. And then there's this kind of sweet spot at 35% down where you're at prime minus 0.75. And then you're looking at prime minus zero point 0.6 for 25% down and 20% down, and prime minus 0.25 if you're getting one of those insurable mortgages that typically cost more. Now, if you're considering a variable versus a fixed right now and you're expecting that interest rates are going to come down a ton, keep in mind that at prime minus zero point 0.9, you're looking at 6.1% on a variable rate mortgage. Relative to a fixed rate mortgage at 5%, that means that the Bank of Canada is going to have to drop rates probably 5 times before you're even on the interest rate. But that doesn't mean that you're going to be even on the interest cost because in order for you to actually save money with a variable rate mortgage, you're actually going to have to get significantly more rate drops and get below that 5% to actually be saving money. So, as of right now, the prospects for variable rate mortgages are fairly bad. In fact, I would say it is not necessarily a certainty, but it's highly unlikely that if you were to choose a variable rate mortgage today, that 5 years from now, you're going to be better off from an interest rate perspective. Now, it could be the case. There could be a surprise in the economy that leads to significantly lower rates again, but more than likely, the fixed rate option is going to be the cheaper option. And by the way, the fixed rate mortgages are now priced cheaper than the 1, 2, and the 3 year mortgages, which is again making them a better option than those shorter term mortgages. Now, next, I'm going to get into the discounted rates, and I'm just going to run through these. I'm not going to go through what the actual rates are because what is more important is the problems that are associated with these mortgages. And what we find is that when our clients understand the differences between the discount mortgages and the full featured mortgages, and they understand the potential risks, they typically will pay a little bit more for, let's call it insurance, in order to guarantee that they don't get some sort of surprise somewhere down the road. So, these types of discount mortgages can often come with things like higher penalties, but more importantly, the big risk is what's called a bona fide sale clause. Now, oftentimes, if you ask somebody who is selling a discount mortgage, if the mortgage has a bona fide sale clause, they will tell you no, and then you will find out 3 or 4 years down the road that it actually did. Now, this isn't always the case, but more than likely, if you're paying a significantly lower interest rate, it's going to come with that sort of clause or some other form of feature stripped out of it, which becomes problematic if interest rates go down or if you need to refinance because you only have one option, and that is the lender where your mortgage is at. And when you only have one option, you lose your negotiating power, and therefore they pretty much have you over the barrel, which means that if you want to change something that's to your benefit and they don't like it, they can say no. And your only option is to sell the property or just wait it out for the remaining 5 years. And this is going to become very problematic in the event that short term rates go down. And if those short term rates do end up going down and there's an option to get a lower interest rate, but you've got one of these discount mortgages, there's a low likelihood you will be able to benefit from the lower interest rates. And then last but not least, I'll take you through real quickly the 5 year variable rate mortgages. These are very problematic because these are discount mortgages. And if you decide you need to lock in, well, if you've got one of those bona fide sale clauses and you have no negotiating power, they get to dictate the rates that you lock in at. So, in my mind, a discount variable rate mortgage is probably the worst mortgage that somebody can choose right now. And in fact, over the last 5 years, I can only think of one client who, knowing all the risks, actually chose one of these mortgages. So, those are the rates for May of 2024. As you can see, they are jumping around, bouncing all over the place. Do yourself a favor if you're going to be in the market for a mortgage, find a great mortgage broker. Again, you can find one at Mortgage 360 and make sure that you are thinking well in advance. Get those rates locked in so that in the event that bond market yields jump unexpectedly, which they can do, you are protected from rising interest rates. Oh, and one last thing, just because the Bank of Canada lowers their interest rate, which it looks like they're going to do in June or July, doesn't mean that those bond market yields can't go up at the same time and that fixed rate mortgages can't get more expensive. Oh, and if you want to know more about choosing between a fixed and a variable rate mortgage, I just did a brand new video on this exact topic, the major mistakes that people make when choosing between a fixed and a variable. Make sure you check it out right here.